Welcome to the trade. Before we get to the charts, let's take a look at what's going on at a macro level. Iran and the United States have put forward contrasting agendas for talks aimed at finding a lasting peace in the region. The talks due to take place in Pakistan on the weekend will be led by US Vice President J.D. Vance and Iran's Parliament Speaker Mohammad Khalibaf. Iranian officials have questioned whether the ceasefire could hold because they say it's being undermined by Israel's continued attacks on Lebanon as it targets the Iran-aligned militia Hezbollah. Israel pounded Lebanon with its heaviest strikes yet overnight, killing hundreds of people and drawing a threat from retaliation from Iran. And in the US, minutes from the Federal Reserve's March meeting showed most policymakers were worried that a protracted war could hurt the labour market and would warrant lower interest rates, yet also noting the risk to inflation that may ultimately warrant rate increases. US Treasury yields initially fell following the ceasefire, then rose on the possibility of violations. The US two-year yield rising to 3.79%, the 10-year at 4.29%. Australian three-year government bond yields rose to 4.63% and the 10-year at 4.97%. The US dollar having slumped, wiping out most of its gains of the year. The Aussie rising to 70.4 US cents. Well, earlier I caught up with Jason McIntosh from Motion Trader to get across the charts and what he's seen there, particularly given that recent relief rally.
Fascinating day to be talking about some charts. We went from peak fear a couple of weeks ago to now, I guess it's hopeful anticipation that the worst may be over. So yeah, look, let's look at the at some charts, starting off with the ASX 200, and just look at the volatility. So the ASX 200 had a 10% decline in 14 trading days, and then that's been followed by an 8.5% rally in just 10 days. So that's the classic V-shaped structure, and these are often event driven, and what we get, there's panic on the way down to sell, and then on the way back up there's a rush to get back in when the situation appears to go from bad to maybe less bad. It's interesting, we started to see the local market become resistant to selling last week. So the ASX 200's low was more than 2 weeks ago. It was on the 23rd of March, but the low on the S&P 500, that was a week later. That was on the 30th of March. And leading into the 30th of March, that included 3 days of heavy selling. And if you look at this chart, the local market didn't come close to retesting that low from 23 March. So we have an instance of decoupling from the US, and that's something we don't often see. So that's interesting in itself. I spoke about this last Friday in my weekly strategy session, and it was an indication that peak fear had passed. But does that mean the market's heading back to new highs? Well, I think there are two key things to note. Firstly, the rally back above the moving averages, I've got the 1500-day moving averages on this chart, the rally back above those averages, it disengages the downward momentum and it removes the vulnerability that was present when prices were below the averages. People are often worried about market crashes, and it's when prices are below declining moving averages that the crash risk really increases. We no longer have that condition. The bad stuff tends to happen below the averages, not above them. The other thing to note is the strength of the rally. So it's been a powerful move, which indicates aggressive buying. So that's how many bullish phases start. It's when we get a shallow rally that struggles to move higher, that's when I get most concerned. That's a sign the rally's being sold, and that's clearly not the case here, so that's positive. I want to quickly look at two of the key main sectors of the local market, that being materials and financials. So just starting with materials, and this is where we find all the big mining stocks in the materials index. And so the move back above the moving averages, it disengages that downward momentum. But the strongest part of the snapback is probably now over. I think a likely scenario is that prices now form a big range between the March high and the recent low. Materials remain in an overall upward trend, at least I think they do, but I think it's going to take time. I think it's going to take time to consolidate that 83% rally we had off last year's low. Like, that's a huge rally. These big rallies, they take time to consolidate, and then time to repair the technical damage of the recent sell-off. But I think the positive here is that as it stands, the overall structure is still positive for the materials, which should be supportive for the ASX 200. And then we have the financials. We've got the financial index next to have a quick look at. What's interesting here is that financials never broke down. During all the turmoil of the last month, financials didn't break down. They've essentially been range bound since late October. You can see that blue square on the graph. There's also a series of rising lows since December. So the underlying structure of financials remains supportive. When we bring all this together, I think we've had a volatile pullback in the ASX 200, not the start of a longer lasting bearish phase. That said, I don't think we're going to get a quick breakout to new highs. I think a more likely possibility is the ASX 200 continues to trade in a range, maybe for several months. Andrew, this is where I think a good trading plan is so important. It's like, just as I didn't want to panic out of stocks on the way down, I equally don't want to panic into stocks on the rebound. For me, it's about acting systematically, not emotionally. I know it's easier said than done, but that's what a good plan helps us do.
So, Jason, that's what's transpired here locally. Let's move to Wall Street. Once again, that session just gone. Very impressive gains. Talk us through the trends you're seeing on the S&P 500.
Andrew, so I think the big question here is, should we trust this rally? And so starting with the positives, the S&P 500 was showing signs that the bearish positioning had gone too far prior to Wednesday's rally. And it's hard to pick up on this chart, it's hard to pick up on the detail, but just in the last week, prices started closing near their highs for the day. So that means they were holding on to their gains that they were seeing in the daily session. Now, this is something the S&P was struggling to do in recent weeks. So we had that subtle change happening in the price action. And now we have a gap higher on the back of this latest news out of the Middle East. Now, the gap takes prices back above the moving averages. So that disengages what was a highly vulnerable setup from just a week ago when the S&P 500 was on its lows. And when the market was on its lows just a week back, it really had that possibility of a fast decline. That was a real possibility. But I think that that possibility is now disengaging with that momentum move we've just had to the upside. But that doesn't necessarily mean that prices will keep moving higher. I think the key now is whether the S&P 500 can hold onto these gains, and is there follow-through buying. This is so important now, and this is where we need to be careful. We don't want to make the mistake of having short covering rally convince us that something else is happening other than, we want to see active buying of the dip. That's why the follow-through buying is so important. So what happens over the next few days is important. I've got another chart I want to show you for the US markets. It's an ETF which tracks the Magnificent Seven. So this is those big caps, Nvidia, Apple, Microsoft, and the like. Now, there's also the question of market leadership to consider, and this is what this group is also important about. This remains a technically weak structure. So yes, it was an up day with the rest of the market on Wednesday, but look at the close. Look how the price action behaved. It gapped higher on the open, and then selling came in through the day. The ETF closed near its low. That's not bullish price action. It's a sign the rally was being still sold. That's not to say this group of key stocks can't stabilize and the structure can't improve, but I think there's more work to do. Prices are still below declining moving averages. There's still an unbroken series of lower lows and lower highs. So I think it's still a case of proceeding with caution, not getting carried away by what's been a really impressive rally, but seeing if we get that follow through buying and really, Andrew, I think letting this price action develop.
Jason McIntosh from Motion Trader, and that is the trade.